Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.18, which is slightly down from last week's 6.21. So we had the FOMC meeting. There was a cut, but rates don't seem like they're dropping down below where they were weeks prior. So we're going to get into why that might be and what is coming up for the new year and expectations for going into 2026. So let's get on over to the charts. As you can see on this US 10-year chart, rates have not come down from their lowest point, which was right back at the end of October, around 3.938. Now that's for the US 10-year, which translated to, I want to say it was like the low sixes for the average 30-year fix. But we have seen the US 10-year steadily climb, which is not great news for interest rates. Now, it's not going crazy, right? Let's see. This was back in May of 2025, and that's our highest point that we've had so far in the past year. Yeah, I believe so. Well, actually, you know what? In January, it was higher. But, you know, well, I guess let's look at this. So, really, we've been having where the rates will pop up, but not quite as high as they were before. So here's a high, here's a high, here's a high, and then around here is a high. So the rates aren't popping up that much really relative to what we've seen in 2025. And it looks like in the long term, it's definitely possible for the rates to come down. And I'm going to get into that in a little bit. But really in the short term, moral of the story is that the rates have come up a bit from their recent low at the end of October. Now, one thing that was, talked about a lot was the Fed cutting rates. So blah, blah, blah. That means that the mortgage rates have to come down, and that's just not the case. And I know I say this a lot, but it's just really important to understand that the Fed is not cutting mortgage rates. They are cutting the federal funds reserve rate. And really what's more important in my perspective is where inflation is. So let's take a look at the bond market. And of course, the 10-year yield is going to have a negative correlation with the bond market. If people are not buying bonds, then of course there's going to have to be a higher yield to attract people to buy bonds, right? Now, why might someone not want to buy bonds? A bond is, of course, an IOU from the government, if we're talking about government-backed bonds. And this is saying, if you give us money now, we will give you your money back plus a certain interest rate return on that. So, so you're making a little something. And that is what the yield is. Now, if the yield is not that high, let me backtrack. So if inflation is ticking up, you're going to have a higher yield, right? Because let's say it's a 10-year note, right? So US 10-year yield, if it's a 10-year note, let's just say for simplicity's sake, it's $100 bond. So, $100 in 10 years does not give you the purchasing power as $100 today because of inflation, right? As inflation ticks up, bond buyers will require higher yields in order to make it make sense. Why would you, if inflation is sitting around, 2.73%, whatever it is, you're going to need a higher yield to attract those bond buyers. Because if not, it makes a lot more sense to put your money in maybe the equities market or some other investment tool in order to get your money's worth. It doesn't make sense to park money in the bond market with raising inflation and then have that yield be low. That you're just kind of throwing away your money at that point. And right now, the Fed has a dual mandate as espoused by Jerome Powell every time he speaks. The Fed's dual mandate. It is to help the labor market and to ensure that inflation is receding. Now, the Fed has decided to cut rates, and we can actually go, let's see if we go to this Fed Watch. We can see the likelihood of further rate cuts in the future. So next meeting is January 28th, 85% chance of a pause. And then we are expected to get our next rate cut in 26, another one at the end of 26. But then after that, it's just expected to pause for 27. Now, these could shift, 27 is a ways away, so we have to see what happens with the economy. But the Fed has decided to cut rates, but not everyone in the Fed is on the same page. There were definitely some people that dissented to the rate cuts. One of the concerns is inflation. Let me see if I can, how far back I can go. Well, we can take a look at our last inflation metric, which is CPI. So 2.7. All right, it was forecast to be 3.1%. And previously it was 3%. So this would make it seem as if inflation, while it's not gone, there's definitely inflation still. This does not mean that there's no inflation, but it just means that the rate of inflation has decreased. But if you actually go in and look, and I wonder if I can see this. I don't want to get too into the weeds with this. Maybe I can. Can I see this? Latest release. Okay, I can. So, look at this. For October of 25, November of 25, we had no data except for gas and then used and, let's see, new vehicles and used vehicles. Used and new vehicles. Now, these are volatile goods. Whenever you are looking at CPI, when you're looking at core CPI, you take away gasoline and food. So, and the reason is because those are, pretty volatile in terms of their inflation data. So they are subject to change pretty drastically. But there's just no inflation data. So to say it's 2.7, I mean, this is just flying blind. They have no clue what the data actually is. They have no idea what inflation really looks like. And this is represented in the bond market. That's why the 10-year yield ticked up. Let's see, what day did this come out again? December 18th. Let's see what happened December 18th. Okay, so December 18th, it looks like the yield slightly came down, but then it popped back up the next couple days. I just think that the bond market is very skeptical. And I think economists and investors overall are skeptical of the data that's coming out. There's just not enough data to support what's going on. So that matters. It matters if inflation is actually worse than perceived. Because, bond market participants don't want to buy unless the yield is going to be higher. So that's kind of my rant on that. That's my ideas on the bond market. What is? Oh, I don't want a daily view. I want a weekly view. But that is why, I think that the rates are not coming down, and we really had to wait and see what other inflation metrics are looking like. I think inflation is going to be the key thing to watch, and of course we want to keep an eye on the FOMC meetings because we want to see what Jerome Powell says, because that influences a lot for the forward-looking mechanism of the market. But yeah, I mean, we need to see what's actually happening with the economy, what's actually happening with the inflation metrics. We can't just have blanks for everything but 2 categories and then just say, no, it's fine. Don't worry, inflation's coming down. That's just ridiculous. It's ridiculous. Okay, so let's see. This week, pending home sales month over month, up 3.3%, forecast 1%, previously 2.4%. So people are buying. That's good. Even though we're talking about the U.S. 10-year popping up, like I said, long term, in the long run, it's still, lower than it had been for a good bit of 2025. So, definitely don't forget about that. And realize that rates are not terrible right now. So people are still buying homes, pending home sales. That's good. Let's see. FOMC meeting minutes. This is where there was a headline that I saw where there were dissenters, of course, for the Fed cut. And really the only way that we're going to get more cuts is if we get inflation to come down, and I think if we have meaningful data, So let's see. So December 31st, we are going to have unemployment claims, and then it is New Year's. So markets will be closed. Everything will be closed, hoping everyone has a happy New Year's. And then next week is going to be a bigger week, right? So this is manufacturing PMI. This is JOLTS, job openings, employment change, unemployment claims, let's see, average hourly earnings. So it's just a lot of labor data that's going on next week. And that's always something to watch out for because, right, that's part of the dual mandate. Even though we want to watch out for inflation, we do still want rate cuts, of course, because that is... It's good in the sense, right? We don't want rate hikes. That's probably definitely not going to help the, I won't say definitely, but it's probably not going to help the 10-year to come down. Rate cuts are definitely better, but like I said, inflation is going to be a very but a very key thing to look at. But labor is too. That's the other side of the equation. So we want to keep an eye on labor. We also get housing starts, building permits, housing starts, but that's September data. Okay, so we're going to get September data plus last month's data, which would be, I guess this is December. Yeah, I guess. Yep, and then we get consumer sentiment and inflation expectations. So, of course, inflation expectations, this is probably going to be meaningful for the bond market too. All right. Like I said, 6.18, down from 6.21. I mean, just look at this, right? This is for 25. Let's see. Yeah, starting 25, the average 30-year was 7.04, and now 6.18. So definitely better. And that's everything that we got for you. So we hope that everyone had happy holidays. Happy New Year's. And if you are looking for a mortgage, looking to refinance your property, give us a call at 877-TEAM-MBL or visit us at www.mortgagesbylinda.com. All right. Have a great week, everybody.